As human beings, we really don't like uncertainty. We don't operate very well in uncertain environments. And yet that's exactly what the market is all the time. You go to the market every day and you have to deal with uncertainty.
You have to have a passion for the market. So you have to be able to think and you have to have a passion for it. Those would be the two personality traits that I would say are most important.
My fundamental knowledge is the first thing I go to. And I find that US indices react more to what the market mood is by the underlying fundamentals than a Forex pair would.
My play for the NASDAQ is one last run up to give this high a go.
The ability to go into a trading room like HowToTrade and get perspectives from all over the globe.
We have everybody from everywhere that trades all kinds of different things, all at different stages of their journeys.
You truly get really a broad view of the markets and viewpoints that aren't necessarily the same. And always remember, there's somebody on the other side of your trade.
In my opinion, our far right, our outliers here are being wildly undervalued.
It's okay to be a beginner with us in our community, and it's okay to have some experience.
If you've got a community there and people around you, whether you're not necessarily just talking about the markets, but you're talking about something else to take your mind off it, that community feel gives that.
We have a fantastic academy. You don't get educational content that runs alongside prop firms and live streaming and experienced members as well with trade ideas. You don't get that unique combination all in one place that often, and you do get it with HowToTrade.
And that's really powerful, I think, in terms of having that course in front of you that you can learn from and perfect, and you can tweak fit to how you feel suits, and then become funded from that.
And be a true entrepreneur, really, and try to level up in life.
It's just a question of applying it and then the trade ideas that come as a result of that, and then all of a sudden, bang, you've got a great trading edge.
Get good at one market. Get good at one type of analysis. Get good at what you're comfortable with.
It doesn't matter what you're doing. If you're persistent and you're willing to learn from your mistakes, you'll get there in the end.
But you always come back to the table, and that's how you know you're a trader, when you're always there.
Well, good morning to you in the States. Hello, good afternoon to you in Europe, and wherever you are joining us from around the world. It's really good to see you. Hello and welcome along. We have got a pretty special day ahead of us now. It is the US CPI print, and with the emphasis on inflation data and jobs data really dominating the headlines in financial markets around the world, it makes today's print especially important given the disconnect that we have between markets and the Federal Reserve. So good morning to you guys. Good afternoon to you, Connor. Shane, how are you doing today?
Doing very well. Bright and early, Nick. We're ready for a big number. The Super Bowl is Sunday. This is the Super Bowl of the finance today. I mean, this is a big deal. We're ready for volatility. I'm ready to go.
Yeah, I think it's going to be a really good one. Connor, I believe you're not feeling particularly well today. So thank you very much for managing to sort of, dig yourself out of your sick bed to come and, that's dedication to the cause, Connor. Absolutely.
Yeah, I know. The CPI print prospects are keeping me going, so I do apologise if I sound a little bit dodgy, but I am ready to go. I promise. The prep work's gone in, no matter what. So yeah, I'm doing well, and hello to everyone in the room and on YouTube as well.
Yeah, it's really good to have everybody. Yeah, we are live on YouTube as well. So if you are joining us for the first time, welcome along. We cover all kinds of market moving events every single day in our trading room. And on the really big stuff, we definitely try and reach out and sort of cast that net as broadly as possible. So we have got CPI inflation data out of the US today. We've got 4 key metrics that we're looking for. And the market overall is looking for a downtick. We're looking for 6.2% from the previous 6.5%. But, we're in the sort of like the camp these days of getting pretty seismic shocks in these data releases. And the last time we had the jobs data, 517,000 new jobs out of the US, it really sort of it caught everybody off guard last time that happened. And I put together the clip of that reaction. If you ever wanted to see like authentic market reactions of how it can really create shock, just watch the reactions on our faces to this clip. 517. Wow.
Good Lord.
What?
That's a major right there.
Wait, did I just hear that right? 517.
517. Wow.
That is major. My goodness. Wow. Yeah, that was Yeah, I mean, those are real reactions. I mean, what did you guys make of that?
He was winding me up.
That's why we trade. That is why we trade right there. You get a big surprise like that in a print that just comes out of nowhere. I'm curious if we're in for something similar today. I really am. We'll see.
Yeah, it's going to be interesting. I mean, it's definitely, that when you see like genuine market reactions, and then the market prices that in very, very, very swiftly, and we saw quite a seismic hawkish reaction straight off the back of that huge, great big jobs number. But we've had two key chances to see Jerome Powell speak. One at the FOMC meeting a week or so ago, and then he was at the Washington Economic Club, which we covered live in the trading room the other day. But it's interesting to see that it actually caught the Federal Reserve off guard as well. And we've got a bit of video where he just explains that they also at the Federal Reserve were pretty much, they didn't expect a jobs number to be quite that high.
Had you known that the jobs report was going to be as strong, would you have done 25 basis points or something different?
So we don't get to play it that way, unfortunately. We have to, but I'll take it this way. So the message we were sending at the FOMC meeting last Wednesday was really that the disinflationary process, the process of getting inflation down, has begun, and it's begun in the goods sector, which is about a quarter of our economy. But it has a long way to go. These are the very early stages of disinflation. Then comes the labor market report for January. And it's very strong. It's certainly stronger than anyone I know expected. And so, but I would say, we didn't expect it to be this strong, but I would say it kind of shows you why we think that this will be a process that takes a significant period of time.
Yeah, really interesting to hear that Jerome Powell, those guys, they get sort of taken aback by the jobs data as well. But what I thought was interesting about that one, Connor, is that he's basically saying that while that really, really proves a strong jobs market that we've got at the moment, because it is a very strong, tight jobs market at the moment. But what he's basically saying there is that it demonstrates to everyone, including the market, that this whole process of dealing with inflation is going to take a long time to actually filter through the system.
Yeah, and I think I do believe that's what he tried to say.
Yeah.
But I was a bit disappointed because he didn't say that initially. The first thing he said was, his first point of call was, he swerved the question and then said, right, so what we said was we're happy about the and then started saying the words disinflation. So I think, he had a chance there to I think really assert what the Federal Reserve's message is. But his calmness during that whole thing was just crazy. He doesn't care what the markets think and what their measurements are. He's very relaxed about what the Federal Reserve is seeing, and he's got no issue with the markets having a different measurement. So I do believe in what you're saying. He that was his message, but he didn't deliver that, I don't think, in the way that he wanted to, because the first thing he said after that was disinflation, and how markets will jump onto a word like that straight away. And that's when we saw that potentially dovish play.
Yeah, we've got one more clip to play off the back of this. And this is from the FOMC meeting itself, when he was asked by a journalist from the Washington Post about the jobs market, because we have got a relatively contained unemployment rate. It is a low unemployment rate at the moment. When he was asked about that, he was very interested that he actually signposted that clearly the level of unemployment requires new forecasting from the Federal Reserve. And that is something that they're going to be looking at doing in the March meeting.
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage.
Oh, sorry.
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
We're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But we'll update those forecasts in March.
Yeah, clearly seeing that unemployment needs changing. There's going to be revised forecast employment. Do you think that's a big deal, Shane, as we go into March? And we've also got the potential for rate hikes in May as well. Do you see that as being like a key factor in the decision process from here?
I think so. I mean, the jobs market's always been the Fed's silver lining. I mean, throughout this tightening process, they've always been able to point at the jobs market and say, hey, what we're doing, we are in policy, what we're doing is working. And now we're looking at a situation where we may not have to go over 4% unemployment. The Fed was prepared to go over 4%. They were going to live with that pain to get that pricing stability back where we needed it to be, to make sure that inflation is not entrenched. We've heard Jay Powell over and over and over again say we are going to bring pricing stability back down no matter what. And that's why sort of what Connor was saying, we can't figure out why we see every time Jay Powell talks, we see a dovish reaction in the market, because the tone has not changed since Jackson Hole, Nick.
Yeah, it really hasn't. No, they're sort of. He was in that Washington Economic Club interview. He was pretty relaxed all the way through it. So it's an interesting question as to why we still have this disconnect. And I just want to, before we get the print, we've got 20 minutes to go before the actual DAISY gets released. And I'm curious as whether CPI is going to be a referee today between the market and between the Federal Reserve in terms of what they want. But what I think is interesting, I mean, Shane, you're a massive Fed watcher from the Fed Watch tool. Those interest rate traders that really put their money where their mouth is, and they stick a position on to tell them, to sort of indicate to the market what they believe is going to be moving forward. I thought it was particularly interesting the way that map has now shifted. In this graph here that you can see in front of you, don't be sort of bamboozled by the sort of the intricate detail of the actual chart. This spike right at the end, that is off the 517,000 jobs print that we had at NFP. And as soon as that happened, what that indicates is that the interest rate traders said that an interest rate hike of 25 basis points in May is pretty much on the cards. It's interesting to see how we can use these sorts of tools to sort of forecast where the market expects those rates to be over the coming months.
Yeah, it wasn't too long ago where we were talking about an emergency rate hike in May. Maybe it's an emergency. And these markets priced that in so quickly after NFP. It really was astounding. And the biggest thing I want to tell everybody is don't get buffaloed, don't get intimidated by something like the Fed Watch. Like Nick said, it's just a way that long-term hedgers can take positions on interest rates in the future. That's it. But what it can tell us, it can give us probabilities of when and how the derivatives traders believe the Fed's going to adjust interest rates. And that chart right there, you can see that trajectory towards a May rate hike was really a quantum. It really was a big time shift in perspective. And it's only developed over the last 2 weeks. There's a few other things there. For our March meeting, we're pricing in about an 85% chance of a quarter point rate hike. We're also pricing in a 15% chance of a half point rate hike. Those expectations could change dramatically here in the next 30 minutes. Yeah, they really could. So for me, I'm still leaning towards that initial market call we made back in January, maybe going off the board for 2023 with a 5.25 rate. I think that's very possible and in play right now.
Yeah, I would agree with you. We've got to ask ourselves, if the market is pricing in, if the market is expecting a rate cut, now where is a rate cut like that going to come from? I mean, how is it going to? I mean, we put together a few basic scenarios that Connor's put together this morning of very, very simple ideas of how we could potentially see a rate cut this year. I mean, it's not sort of like, I actually don't think we're going to get it, but Connor, just talk us through how these particular dynamics could work. If the market is saying, yeah, we're going to get a rate cut, where are we going to get it from?
So the first thing is it explains sort of the narrative and the direction that I've been on in the stock market this year, really, which obviously hasn't been playing out the way that some people have expected. So when I look at the reasons and the situations that would occur if we were to see a rate cut, then we'd have, first of all, we've got over tightening. So that's if the Federal Reserve goes too far in their mission. And essentially what that would look like is, significant softening in retail sales, consumption, of course, the jobs market, but, a significant fall. And therefore, they would need an emergency cut to sort of compensate for that fall. That leads into the fact, we're looking at potentially a deeper recession. And if we're looking at a deep recession, as those retail sales fall, housing market collapses, jobs numbers fall, then there's going to be a lot of pressure on the Federal Reserve to stimulate the economy again, of course, once you're in a recession. Or we could have something like a war shock, because we know what's going on in Russia at the moment. They've stepped up the offensive. That was always on our radar since the beginning of the year, with the conditions improving for offensive tactics now in Ukraine. They're stepping up. I saw a news article earlier that they're heading now towards another major part and a major landmark in their goal, in Russia's goal. But what those three situations would mean, that none of them are positive for equity prices.
No.
None of them.
No, none of
So the fact that we're seeing, equity prices rise off the back of, potentially a rate cut at the end of the year doesn't make sense to me. And that's that disconnect there, because those three reasons why are potentially, reasons that the equity market's going to fall. Yeah. Or, of course, you can add a fourth reason in there, and the board would come and say to me, okay, but if the Fed are cutting rates, inflation's falling down steadily, the jobs market isn't collapsing, it's remaining fairly strong, retail sales is okay, and basically that's just soft landing narrative, then okay, fair enough, I get it, but I see that as a 10 to 15% probability maximum.
Yeah, they're very, very clear reasons, and it's a question of whether we're going to get any of that or not. I mean, to be honest with you, I can't see how we are not going to get we are going to get some recession. Over the last week or so, there's been some dialogue saying not only are we going to get a shallow recession, but we might not even get a recession at all. So I thought about that a little bit, and this next chart is really, really interesting, because this here in front of you, there's a very key metric, and it's called yield curve inversion, which is basically where borrowing costs at the shorter end over the short term, they tend to be the yield tends to be a lot higher. The rate of return tends to be a lot higher on the shorter months than it does in 5 years, 10 years, 15 years, 30 years into the future. Now that relationship shouldn't exist, and the generalized thinking is that once you do get interest rates at the front end that are higher than they are into the future, that is called a yield curve inversion. That tends to be a signal that a recession is on the cards. And this chart in front of you here, what this shows you is it shows you all of the top countries in the world, all of the AAA rated, the A to AAA rated countries around the globe that are currently sitting with a totally inverted yield curve. And the list is absolutely astounding. I mean, you've got Chile, the Czech Republic, Malta, Canada, Iceland, the United States, Qatar, Sweden, Hong Kong, Germany, New Zealand, Denmark, Israel, United Kingdom, Norway, South Korea, Netherlands, Poland, France, and Singapore. They all have inverted yield curves. So how anybody thinks that we are going to avoid a recession at this stage is it's a very strange way to do it. But we do have this disconnect between markets and the Federal Reserve. I mean, what do you think about the prospects of a recession coming up by the time we get to like quarter two?
Well, if I told you just quickly that that yield curve inversion you're talking about, if we're talking about the US and the 2s and the 10s, yield curve inversion, that yield curve is inverted more now than it was before the global financial crisis and the dot-com bubble. 70 basis points at the moment, roughly, yield curve inversion. So I don't know what you think about that, Shane, but you can say that history repeats itself, I guess. I'm not saying we're going to have a crash like the global financial crisis, of course, that'd be so cool. But the evidence is there definitely for me.
Yeah. I mean, we go over the 3 and 6 month. I watch those very closely every Monday, those auctions. And when you bring up 2008 to 2012, our charts, we always put things in perspective from about a 25-year viewpoint. And you can see a lot of those yields around the world. We're seeing this gravitate back to those levels. And that should scare everybody. I mean, you really should you have to take note of these historical events, and just to put what we're doing in context right now. So for me, I tend to agree with you guys. There's a major disconnect in these debt markets, in your equities markets. I mean, we're bidding crypto, for gosh sakes. I mean, why are we bidding crypto right now?
It doesn't make any sense, does it? Yeah. I mean, the other thing, we are looking for a downtick today in inflation. I'll be honest with you, I haven't actually got an opinion whether we are going to go, whether we're going to tick up or down. I suspect we should be ticking up, but I wouldn't be half surprised if we actually got a move down in inflation today. But I just want to, before we get onto the actual data for today and the charts, because we've still got 10 minutes to go. Before we do that, I just want to highlight that, these things, they do tend to, like COVID moving around the world, we do tend tend to find that things that the economics tends to flow. The flow of money moves around the world as well. Australia, they did have a slight surprise, an uptick in their inflation a week or so ago, and the other day, Switzerland, they posted 3.3%, quite a marked spike in their inflation rate as well. So in some ways, I'm toying with my mind now whether I put it this way: I would not be surprised if we get an uptick in inflation today, and that really would be would start to push equities lower from here. So what do you think? Because all these economies, they are sort of like interconnected. I mean, what do you think about whether can we use other countries' inflation rates as some way, sort of like trying to gauge whether we're going to get something similar in the United States today?
Well, we attempted to do that with the jobs number. If you remember right, we were talking about the unemployment ticking higher in New Zealand, and we were sort of using that as a barometer, and that did not work. So I would be very careful doing that. But one thing I would say, that uptick in Switzerland is a big deal, because if you look at the historic inflation rates in Switzerland, those things have been on lock between 0 and 3% for a long time. And if the Swiss are having problems getting control of inflation there, what's happening in the United States? That was a real eye popper for me.
Yeah, I would agree. Yeah. I mean, we're moving to today's data. What we're going to do is let's just start to break it down. We're going to get four readings of inflation. They're year on year and month on month. Now, if you're new to trading, if you're watching us on YouTube for the first time, don't get sort of phased by any of this. We get basically two blends of inflation out today from the US. We get what's called headline inflation and then core inflation. Now, the basic difference between the two, they're both measuring how much things cost, the price of everything. And as you go down the shops and you do your weekly grocery shopping, you may have noticed that the price of your food, your regular food bill, is potentially ticking up. That is inflation. Everything is getting generally more expensive. Now, the way that economists and guys in the finance industry measure that, we tend to look at not just the price of everything as a whole, but we want to look at it in specific ways. And that's the difference between headline inflation and core inflation. Some different aspects of inflation, it's a whole basket of ingredients that are put into this measurement that give us that overall total. And you can see down here, the headline inflation has been trending down in the United States. But that is basically a mix of the entire the entire basket of goods and services that go to make up that number. When we look at core inflation, what we do is we strip out the really volatile aspects. So we take out the things that where the price really fluctuates a lot. So things like food and energy, those prices on a day-to-day, week-to-week, month-to-month basis, they tend to be pretty volatile. So what they tend to do is if we remove those measurements, because they can potentially skew the headline result, what you do is you end up with a denser, more compact reading of inflation, which is why it's called core inflation. And that's the set of graphs that you can see over there on the right-hand side. So we get a print for headline inflation. That's the sort of thing that you'll see on the news tonight when you watch it and they're talking about inflation numbers. But the core rate is a more compact number. It's stripping out the volatile aspects and it's showing us a more meaningful impact. Now, the way that these graphs work, you can see here we've got the year-on-year rates in the top. That's the year-on-year. This bit here where my mouse is for the headline inflation. We're expecting a downtick today. That will be a dovish reaction in markets. So the market's looking to price the stock markets higher and then also look for weakness in the dollar as a result of that. You can see previously it was 6.5% and we're looking for today it to be 6.2%. If we don't get that, if we get a push higher, maybe back up towards 6.5%, you're probably going to see the stock market want to trade back down to the downside. That's potentially the headline inflation. The graph under that is a faster measurement. That is literally just month to month. So instead of looking how we're comparing ourselves over the course of the year, the actual month to month reading is just a faster reading. But it's still useful. But you can see here where we get a slight difference in the data. The month on month reading is slightly different. We are actually expecting that to tick higher today, 0.4% from the previous 0.1%. So we will be looking for this graph to go in the upward direction there. If you then step over to the core inflation, this is potentially what is almost more meaningful to the market, depending on if we get an inline reading in headline inflation. And the year-on-year rate here for core inflation in the top right-hand corner, you can see it's 5.7%. That was the previous reading, and we're looking for that similar to the headline, we're looking for that to step down as well. 5.5% today in the core reading. Now, the month-on-month reading underneath that one, that's expected to come in line. So we're not looking for any change on a month-to-month basis for core inflation. So it is a little bit of a mixed bag. Now, how can you know what this is? Well, that's incredibly difficult to do, and it's definitely something, not a data number that I would want to try and trade around today. But basically, if we get a reading that is as forecast and is lower than forecast, that will be a dovish play. That is looking for the stock market to price higher and the dollar to go weaker. And then conversely, if we get the opposite, the exact opposite of that. So that is the landscape that we've got. What do you guys think? Shane, what do you think about which way are you going to go? Are you going to go with an uptick inflation from here? Or are you going to go with an inline reading? Or are you looking for it to step down? And which one are you looking at more, core or headline for you?
Yeah, I always look at headline. I don't understand how we can factor out something like energy, but I'm an energy trader, so I'm always watching energy constantly. So I really gravitate towards the headline there. But what I will say is we've seen the transition from those monthly numbers. They're losing a little bit of their importance. We're looking at the yearly numbers now more because we've been tightening for a year. Yeah. So we have to see if that body of work, if that policy is actually impacting things in a meaningful way year over year. To answer your question, Nick, I'm looking for a hot print. Switzerland scared me.
Right. All right, that's fair enough. I agree with you. I'm looking for an uptick in inflation here. I don't think the inflation journey is over. I'm going to go with the Federal Reserve. I'm in line with the Federal Reserve, but I'm wrong at the moment. The market is pushing. It definitely pushed my point of view out of the way. Connor, how do you see it? What are you going to go for? Are you looking for an uptick here? Do you think we're going to get in line, or are you going to sit with the doves? I mean, I know deep down you're a hawk in this.
I know I am. Yeah. Okay. Yeah. I admit I am, but I have to say I'm concerned over the expectation of it to tick higher, because it wouldn't surprise me if we saw the headline CPI coming in at under 6% and everyone thinking that, oh, that's it, inflation's done, we're out of the woods, and we just see a poof in equity prices. But I'm with you in that I don't think that story's over at all. I really don't. And I am on the bear side of the stock market at the moment. So I have to say I've got a little theory in my head that today potentially what we're going to see is a slightly softer CPI print. I hope that's not the case, because obviously what I've been going on about for the last 3 months would be backed up if it was a hotter print. But I'm expecting maybe a slightly softer print and then a huge stock market rally for today. But I don't think the story's over. I think that'd be another trip to Hope Island.
Wow, it's an interesting scenario that we've got in front of us. Let's have a quick check on the markets now. We've got just under 3 minutes to go now. See the US 30. You've got the Dow Jones there in the top left. You've got the S&P 500 in the top right. You've got gold in the bottom left-hand corner, and you've got the Nasdaq in the bottom right-hand corner. Has anyone got any levels that they're looking at? Obviously, certainly looks like the equities are just pushing to the upside, except the Nasdaq, which is just hovering, just starting to go a little bit range bound now over the last few hours. Anybody got any particular levels that they are gunning for, that they are looking at?
I was looking at 12,500 on the Nasdaq. That was on a 4-hour chart. That was sort of a 50% move, 50% of the candle imbalance from the 9th of February that we had at 3 o'clock. So I was looking at that potentially to have a reaction to the downside. It's been a little bit of a grind to the top side at the moment, which is why potentially we actually are shaping up for a hotter than expected print. But 12,500 I think is critical for me for the Nasdaq. Will that act as the support level today, or will we get a break below that and then a retest and then sort of to slump lower? We are spiking a little bit higher in the lead up.
Right. It's looking like we're just over a minute to go now, so I will get the squawk on and I will shout the number out.
Okay.
Okay, so it's not going to be long now.
The volatility.
Yeah, I mean, look at that volatility on the S&P from the Washington Economic Hub. It's just a crazy session that was. 20 seconds to go now, so. 20 seconds, 10 seconds. There we go.
0.5% month on month and 6.4% year on year.
6.4 year on year.
0.4% for the core
Or
figure.
slightly higher.
5.6%. Then the headline number is 0.5% is in line month on month, but it's 0.2 higher year on year. While the core figure is in line month on month again, but the year on year is 0.1 higher.
That's a pretty high number. Big move down on the Nasdaq there. Ooh.
Gold puts in a hard test of 1850 and bounce. Really, markets are going to have trouble digesting this one. I don't know which way this is going to go yet.
So we've got the year on year 6.4, just slightly under the previous, but above forecast.
Yeah.
At core rate, it is under, isn't it, the previous, but it is higher than forecast. Oh, it's a mix. Could be an ugly session, this one.
Yeah, I mean that's a sandwich number. That's almost a throwaway number, Nick. I mean, you're below the previous release, but you're above expectations. I mean, what does that mean?
Yeah, difficult. It looks like it kind of comes across like the market isn't quite sure at the moment, is it? I mean, it printed down to the downside, quite a swift algo move off the actual number, but I don't know.
If you look at what the charts you've had up there and the fall that we've had in the headline figure year on year, 8.2 down to 7.7, 7.7 down to 7.1, 7.1 down to 6.5. They're a 0.5% plus move to the downside, and we're now just 0.1%. So is inflation starting to, it's an early call, of course, but is inflation starting to base out a little bit? And do we want to base out at 6%, 6.5%? So, interesting.
Yeah, interesting one. Yeah. So I don't know. This is one of the reasons why I don't tend to try and trade straight off the news. It's particularly if you get bit of a mixed bag as well. I tend to like to take that information, watch the market reaction, then sort of like pull my trading thinking together a little bit down the line, because obviously bear in mind that within an hour we're going to get the US Open and you're going to get volatility around that. So if you are trading this event and you're a bit confused as to know what to do, you don't need to worry about that. It can be a little bit confusing sometimes, and the market reaction can take a little bit of time to sort of decipher. So for me, I would definitely stay away from actually sort of getting involved in markets, and just remember that within an hour you're going to get that traditional US cash market open, and volatility will come in off the back of that, and then there'll be some clarity painted around the price action. But I was expecting it to be a little bit more a little bit clearer than that. But now equity's really pushing to the upside.
Look at that.
In a big way. That US 30, I mean, that 1 minute chart right there, if you're trying to trade something like that, stops down, leverage, and check. That's all I can say. Best of luck to you. If you're making money, it's the right answer. But if you just pull up the 1 minute dynamic there and it's just an absolute fake out to the downside, and now you have explosive bidding and now we're retracing, I mean, that is difficult to walk out of there with any money. I will say that.
Yeah, very, very tough indeed. Yeah, I mean, let's have a quick check on the currencies as well. Let me just bring up the euro dollar on here. Where is it? I've got it on here somewhere. We can find it. Oh yeah, so traditional. Yeah, so we got it's still intact, and if we just got a slightly dovish reaction from euro dollar as well, pushing back up to 108, just contained under 108.08 at the moment for euro dollar. So I would be expecting, for euro dollar, I'd be wanting to be contained underneath that 2015 yearly close at 108.45 for me. But it's too early for me. I'll be honest with you, it's a little bit too early to say.
I agree. Yeah, it's very difficult. Difficult market to trade. Just looking at the moment, the dollar's taking quite a big hit. Here, but again, I wouldn't be surprised if it then sort of turns in the other way. There's sorts of readings which can wick out in either direction. And as you said, we probably won't get a lot of clarity on that move until maybe tomorrow or US Open today or something like that. So yeah.
No, this is the story of 2023.
Yeah.
I mean, this is thus far, it has been an absolute chop fest. We're not getting those big directional moves that we got last year with the policy. It was, I say it every day on the streams, fairly easy to trade last year. We knew that we were going to hike rates. We knew the dollar was going to go up. And now we're in very compressed. Dollar index is right around 102.75. just an absolute compression pattern if you look at the daily. One other thing, guys, we had some breaking news. It looks like Biden is getting ready to tap Lael Brainerd to be the head of his economic council. That news just broke here a few minutes ago, so we're watching that closely. We will see what Lael has to say about inflation later today.
Yeah, she's very particularly dovish. I think the most dovish of all of them when she was on the Federal Reserve Board. So yeah, very interesting indeed. Gosh, well, I don't know. Well, there's going to be a lot to unpick later on. We've got a whole boatload of stuff coming up in the trading room today. We've got a new feature starting today. We're running it every single month, and it's a new concept that we are trying. We're doing large scale interviews. It's a new stream concept that we're doing. It's called the Diary of a Trader, and it's basically where we connect with various different traders of varying different abilities, and we sort of map out their journey in markets, where they've started from, where they have where they've got to, the problems that they've encountered, and they've encountered any disaster stories, any great successes that they've had, the whole sort of thing from start to finish. It's going to be a fascinating series. We're running it every single month, and it starts today. We've also got some prizes that we're going to give away as well. We've got 3 particular categories of prizes that we're going to award to everybody, to people in the room. That is the best contributor within the website. They get 3-month free access to the website. Also, the most engagement during live streams as well. There's a prize for that. That's a 2-month access pass. And then also most helpful overall in the community, they get a 1-month free access pass. But as a series, guys, it's really interesting to see what other people are trading, how they are dealing with the ups and downs in their own journey. And what's really fascinating is that everybody watching can get something from it, because you'll identify the problems that you have as a trader with the types of stories that we're going to be covering. So I think it's going to be a really interesting series.
Absolutely. I'm looking forward to that one immensely. The biggest thing is you're not alone. If you're a trader in front of the screen and you feel like you're by yourself, one of the great things about our community is you're not alone, and you're going to get to meet some other traders. That's absolutely fantastic, Nick. Looking forward to that.
Yeah, I think it's going to be a really interesting series. So that starts in a couple of hours here in the trading room. So if you are watching us on YouTube and you fancy watching and just starting to pick up some of your own bits of the trading journey and see if they connect with you, come and join in, sign up for a free trial. It's not going to cost you any money to join, just to have a look and then see if it's something that connects with you. It's going to be a really interesting series indeed. But that is pretty much everything that we've got for you today. We've had a very strong jobs number. We've had some real clear thinking from Jerome Powell over the last week or so, and now CPI, which is supposed to bring the market together with the Federal Reserve. That does not look like it's happening anytime soon. Thanks very much for joining us. We've enjoyed your company. Thank you very much, and we will see you all very soon.
As human beings, we really don't like uncertainty. We don't operate very well in uncertain environments, and yet that's exactly what the market is all the time. You go to the market every day and you have to deal with uncertainty.
You have to have a passion for the market. So you have to be able to think, and you have to have a passion for it. Those would be the 2 personality traits that I would say are most important.
My fundamental knowledge is the first thing I go to. And I find that US indices react more to what the market mood is by the underlying fundamentals than a Forex pair would. My play for the NASDAQ is one last run up to give this high a go.
The ability to go into a trading room like HowToTrade and get perspectives from all over the globe.
We have everybody from everywhere that trades all kinds of different things, all at different stages of their journeys.
You truly get a broad view of the markets and viewpoints that aren't necessarily the same. And always remember, there's somebody on the other side of your trade.
In my opinion, our far right, our outliers here, are being wildly undervalued.
It's okay to be a beginner with us in our community, and it's okay to have some experience.
If you've got a community there and people around you, whether you're not necessarily just talking about the markets, but you're talking about something else to take your mind off it, that community feel gives that.
We have a fantastic academy. You don't get educational content that runs alongside prop firms and live streaming and experienced members as well with trade ideas. You don't get that unique combination all in one place that often, and you do get it with HowToTrade.
And that's really powerful, I think, in terms of having that course in front of you that you can learn from and perfect, and you can tweak fit to how you feel suits, and then become funded from that.
And be a true entrepreneur, really, and try to level up in life.
It's just a question of applying it, and then the trade ideas that come as a result of that, and then all of a sudden, bang, you've got a great trading edge.
Get good at one market. Get good at one type of analysis. Get good at what you're comfortable with.
It doesn't matter what you're doing. If you're persistent and you're willing to learn from your mistakes, you'll get there in the end.
But you always come back to the table, and that's how you know you're a trader, when you're always there.